Jeff, it's Dom here. One of the things that we've been paying attention to for quite some time now is the way that the futures curve looks for crude oil prices. We know that current prices and those that are not far off in the future are higher than they are, say, a year from now in terms of the futures market. If that's a situation that is indicative of where prices go in the future, shouldn't we expect lower prices at some point? Or how do you interpret that so-called backwardation in futures that's happening right now for oil?
Absolutely not. Backwardation is a bullish term structure for any commodity market. It means you will pay a premium to have that commodity today, not tomorrow. It means you're short today. When you have a deficit today, it creates that premium in spot prices over the forward prices. And so when we look at backwardated markets, and many of them are backwardated in commodities right now, it's an indication of supply shortages, of scarcity, not of abundant supply. So it does not indicate that prices are going down. And the opposite, when the curve is upward sloping, is bearish. It means you have too much today. So the backwardation or downward sloping forward curve is an indication of scarcity.
So if I might follow up there, if that is the case, if we look towards the way that the supply structure looks in the coming months and years, is it fair to say that we could be back in what some would call a commodity super cycle, at least when it comes to crude oil? It's been called that in the past. We've seen demand destroyed because of it. What changes this time around? How can it be more constructive for oil prices without it being killed by the fact that high prices will cure high prices?
Well, there's two pillars to our thesis of a commodity supercycle. One is a structural rise in demand driven by policy, a combination of redistribution policies that we saw with the recent announcement out of Congress. But there's also the green capex, the environmental policies are driving it. So that's one pillar to it. The other pillar, which I think is critical, is a structural decline in supply due to underinvestment. In oil in particular is severely impacted by this. The case in point, no investment in the U.S. shale patch, no investment in non-OPEC ex-U.S., leaving OPEC really is the only game in town. And so one thing we like to think about this market, it was a demand-driven market over the previous 6 months. Going forward, it's going to be a supply-driven market, and that's structural in nature.